In this lesson, we're going to account for a bond issuance in the simplest possible situation, when the stated rate and the market rate are exactly equal. You'll recall from our bond pricing lesson that this is the case that has no discount and no premium, so it lets us see the basic bond entries with nothing extra in the way. Master this, and the allocation of discounts and premiums will become a small variation on a common theme. Here's the situation. Suppose your company is about to issue bonds with a stated rate of 10%. And right now, the market is also demanding 10% for bonds like yours. The rate you're promising and the rate investors want are identical. So how much will investors pay for your bond? Think about it from the investor's side. They want a 10% return and your bond pays exactly 10%. There's no reason for them to pay you more than what you asked, and you have no reason to accept less. So they pay exactly face value. When the stated rate equals the market rate, price equals face. No discount, no premium, nothing extra changes hands. It's the cleanest deal. Let's prove it isn't a coincidence, though. Remember our pricing formula, discount the cash flows at the market rate. Here's the elegant part. When the rate you use to compute the cash interest is the same rate you use to discount, the math actually has to land exactly on the face amount. The present value of the interest plus the present value of the principal will always add up to face, right on the nose. You can check this on a calculator and it'll click into place. So 3 things are true at once. The condition is that the stated rate equals the market rate. The present value check confirms the price is the face amount. And the result is what we call a par bond. It sells at par, at 100% of face. And we don't need a discount or a premium account at all. That's why this is a warm-up case. Now the journal entries, and because this is a par bond, they're about as clean as it gets. There are 3 accounting moments in the life of a bond. First, when the company issues the bond, it receives cash and takes on an obligation. So we debit cash for the proceeds and credit bonds payable for the face amount. Since the bonds are sold at face, those 2 numbers are identical. Second, each interest period, the company pays the cash interest. We debit interest expense and credit cash. And here's the beautiful simplicity of the par case. Interest expense equals the cash paid. Exactly, every single period. There's nothing to amortize because there's no discount or premium sitting on the books. Third, at maturity, the company repays the principal. We debit bonds payable to clear the liability and credit cash for the face amount. And that's the whole story. Issue, pay, repay. Before we work through an example, I want to highlight why the par bond is such a useful baseline. Nothing drifts over time. Every period looks exactly like the one before it. The cash interest is the face amount times the stated rate divided by 2, same number every period. The interest expense that we record is also going to equal that same amount, again, every period. And the carrying value of the bond, the account sitting in bonds payable, stays parked right at the amount of the face value from the day it's issued until the day it matures. There's no discount to whittle down, no premium to draw off, so the carrying value never moves. It's the moment that the stated rate and the market rate disagree that we have to make adjustments. You might also be wondering, why don't we just change the stated rate on the bond to match the market rate, if that's what bondholders expect? And it's a good question. There's a lot of reasons, but the primary ones are that bond contracts are usually written with nice even numbers, like 5%, 6%. But market rates change often and by fractional amounts, so they're messier than that, like 5.37 or 6.245%. Another reason is that the stated rate is locked in the second the bond is sold, but the life of a bond doesn't usually end there. Like most securities, there's a secondary market for bonds. That bond might get resold again and again. It's not possible once the bond has been sold to change the rate. That initial sale has already occurred. Let's record one together. Imagine your company issues 500 bonds at their face value of $1,000. We can also say that the bonds were issued at par. That means that the stated rate must equal the market rate, and we're able to sell these bonds for the exact amount we intended to when we drew up the contract. All right, let's first price this bond. We know that the stated rate and the market rate are equal to one another, so this bond is going to be issued for face value, but let's just make sure that the math works out correctly. So the first thing that I need is the market rate in my present value calculation. Remember that we are doing 2 present value calculations in one formula in Excel. The 2 present value calculations are to take the present value of the interest that I've promised to pay every 6 months for 5 years at 6%, the stated rate, and then the other promise is that I'll pay back every bondholder $1,000 at the end of the 5 years. So 2 promises. We're going to do the 2 calculations in one calculation. So I need the market rate to start this calculation because I'm going to discount all of these promises at the market rate, 6%. I'm going to divide that by 2. The next thing I need to do is take the number of periods and multiply it by 2 because that's how many interest payments I'm actually going to make. Then I need to figure out what the interest payment is. I'll start by making it negative, and I will grab that face value of the bond and multiply it by the stated rate. But don't forget to divide the stated rate by 2. And then I'm also going to include a negative outflow of the amount that I'm going to pay back in 5 years, and that's the face value. Next, we'll do the present value calculation. And we'll grab the interest rate first, then the number of periods, then the payment of the interest, and then the future payment of the principal. And you can see that the price of this bond, the present value of those two promises, works out to be the face value of the bond. Now I need to record the issuance of the bonds on the first day, January 1st. So I'll debit cash. I'm borrowing money from these bondholders. When I sell or issue a bond, it means I'm just borrowing money. I'm going to pay them back. Issuing and selling just refers to the piece of paper, the contract that I'm issuing and selling. So I need to take the present value of that bond, the price of it, and multiply it by the number of bonds that I've actually sold, 500. Then I'm going to credit a liability account, bonds payable, for the amount that I owe in principal, right? This is the amount that I'm going to pay back at the end of 5 years. It also represents the carrying value of my bonds today. What's in the T account? What is in the bonds payable account is my carrying value. Then I'm going to record the first interest payment that will happen in 6 months on June 30th of year 1. So I'm going to debit interest expense for the amount of that payment. And that is, I'm going to make it an absolute value of $30 times 500 bonds. And I will credit cash. So in this case, my cash payment is equal to the amount of interest expense that I'm going to recognize. The stated rate equals the market rate. Everything is simple, and the carrying value of the bonds will stay $500,000 for the entire 5-year period. To wrap up the simplest bond scenario, remember that when stated equals market, the bond sells at face value. Use the market rate, though, to price the bond, and you'll find that the price will equal face. We'll recognize interest expense equal to the payments we're making each period, so adjustments to carrying value aren't necessary. Next, we're going to look at when the stated rate and the market rate don't equal, and how do we account for that scenario.